here. So tonight's first topic is the limitations on Subpart F. In some of the videos and two of our webinars, we've covered when we have to include Subpart F income, what is included in it, etc., etc. And tonight's topic is going to be the limits on those inclusions. I want to start with repeating something, the no loss rule. The Subpart F regulations say that a loss in one category of foreign-based company income cannot offset income in another category of foreign-based company income. Now, I've mentioned this in one of the videos or one of the webinars, I don't remember which, but I thought at this point it's worth mentioning again. The only way a loss in one category offsets income in another category is through the overall limitation on Subpart F. That limitation is based on the earnings and profits, and we'll go through those limitations in just a moment. I want to first take a couple of detours. First, I want to talk about what are dividends, and then what is E&P. Dividends are distributions of earnings and profits. The distributed earnings and profits moves from the company paying the dividend to the company receiving the dividend. The recipient includes the amount of the dividend in his, her, or its income. As property or money is distributed up a chain of companies, there are successive income inclusions, and the earnings and profits moves with it. Now, Subpart F inclusions are not dividends. They don't move earnings and profits. If I have a Subpart F inclusion from my foreign subsidiary, if I'm a U.S. company and have a Subpart F inclusion, I do not change my earnings and profits other than by the fact that the Subpart F inclusion has changed my taxable income. The E&P stays in that foreign subsidiary. Now, an inherent part of Subpart F, before I go there, let me touch on what are earnings and profits that we're talking about here. This should have been covered in your corporate tax classes. Earnings and profits is just the tax version of retained earnings. There's an old RevProc from the early 70s, I believe it was from 1971, that had worksheets on how to compute earnings and profits. And in the Internal Revenue Bulletin, there were these reproductions of handwritten worksheets. Very unusual thing to come out of printed stuff coming from the IRS. But this was back in the 70s, before spreadsheets. And for a U.S. company, you start with taxable income and make adjustments to it. For a foreign subsidiary, you do the same sorts of things, but you usually don't have taxable income to start with. So you have to make adjustments to whatever earnings records are out there to get to the U.S. equivalent. So again, for earnings and profits, I'd refer you back to your old corporate tax courses. So again, the earnings stay in the company that generated the Subpart F income. When a shareholder picks up any Subpart F income, it hopscotches. It skips over any intervening foreign subsidiaries. The E&P does not flow up. The 902 credit doesn't flow up. The intervening company does not have a pool of taxes. Now, I'll caveat this last statement. The intervening company doesn't have a pool of taxes, but where we have Subpart F inclusion and taxes flow up to the U.S. shareholder, are deemed paid taxes, we have to limit the amount of deemed paid credit as if the earnings and taxes had flowed up the chain. This is a fairly recent change to the law regarding Subpart F. The earnings hopscotch. They skip over intervening companies. The taxes hopscotch. They skip over intervening companies. However, the foreign tax credit at the U.S. shareholder level has to be computed as if everything had flowed up the chain, as a limitation, not as an increase. So that can get pretty complex under the current law. So let's go to our limitations on Subpart F. Before I do the 952 limitations, and I realize there's no slide on what I'm about to cover in the presentation you got. We've got two E&P limitations that can apply. The first one relates to Section 956, and it's built in to Section 956. 956 is an inclusion of earnings invested in U.S. property. It has two parts to it. There's the earnings and the property. So if we don't have any earnings, meaning earnings and profits, then we don't have any 956 inclusion. The 956 amount is based on either current or accumulated E&P. This works just like dividends. If there's a deficit in accumulated E&P, but there's current year E&P, then there's a potential for inclusion. But if both current E&P and accumulated E&P through year end are 0 or negative, then there's no 956 inclusion. Now there's a second aspect of 956, and I mentioned this in the 956 area, but I want to do it again. The second aspect takes into account the aggregate prior inclusions under Section 956. The current year inclusion is the lesser of E&P or the investment in U.S. property reduced by aggregate prior inclusions. Now for this I do have somewhere here bear with me a second. Now, sorry about that. I thought I did. I will distribute an example on this 956 limitation, and I'll put some audio with it. The rest of Subpart F has a second aspect of limitations, and that's an overall E&P limitation. Subpart F income means that those items earned by the CFC during the current year that fall into one of the Subpart F categories, like foreign personal holding company income or foreign-based company sales income. The Subpart F inclusion means the amount the U.S. shareholder must include in his, her, or its income. Subpart F income within a CFC is limited to the current E&P of that CFC. It's a current year only item. This is not the same as a dividend. It's not the same as 956. It's just current earnings. This E&P limit is an overall limit on Subpart F. And there are rules within this limit on allocating any deficits in the current year E&P to what gets treated as income. And we'll cover an example of that in a moment. In addition to the current year limit, prior deficits in earnings and profits can reduce Subpart F income. When there was a prior E&P limit on Subpart F income, then any future earnings are recharacterized as Subpart F income. That is to say, any prior reduction of Subpart F reverses when we have future income. So let's get to how we go about getting to this E&P limit. Oops. And I've lost my place here. Sorry about that. So the first step of Subpart F is we have to determine net income by category. And bear with me a moment. Yeah. The categories are foreign personal holding company income, foreign-based company sales income, foreign-based company services income, foreign-based company insurance income, and foreign-based company oil-related income. So those are the categories of Subpart F income. You'll notice none of those categories are 956 inclusions. Those are handled separately. So this E&P limit on the Subpart F inclusion is separate and apart from the 956 limit. These net Subpart F income items are determined as if we were determining taxable income under U.S. principles. This may differ from E&P, so our Subpart F income number may be different from the current year E&P for each of these items. So again, first step, determine Subpart F income. Then second step is determine the overall earnings and profits of that particular corporation for the year before payment of any dividends. Then we limit the Subpart F income to that total E&P for the year. Next, if there's any Subpart F income left, we reduce that remaining foreign-based company sales or services income only by any prior deficits in E&P in the same line of business. Then, as a fifth step to this process, we determine what reallocations between types of income are needed to accomplish this end result under the ordering rules. In later years, where we have income, we reverse these last two steps. So let's take an example of how that works. We've got foreign-based company income in 2013, foreign-based company sales income of 100. Other sales income has a loss of 180, and we have passive foreign personal holding company income of 200, so that our net E&P is 120. However, we've got preliminary subpart F before this E&P limit of 300. So we have 300 of subpart F income and 120 of E&P. Our subpart F income is limited to that 120 of E&P, and the difference, the 300 minus the 120, is a deferred deficit that we have to track in the future. This is not a deficit in E&P, it's a deferred amount under subpart F. Now we have to figure out what that 180 relates to. Well, 100 of our deficit was used to offset foreign-based company sales income. So these two offset one another. We had 180 of deficit. The ordering rule says first apply to the deficit to the same category of subpart F income. Then if there's more deficit that got used, apply it to other categories on a pro rata basis. So 100 of our deficit is allocated to foreign-based company sales income, and 80 is allocated to our other subpart F income, in this case, foreign personal holding company income. The balance then is our subpart F income, this 120 that we calculated above, and the shareholder has to include that much in income. Now in this case, our entire balance is passive income. So our shareholder has an inclusion of passive income of 120. And this deferred deficit consisting of passive and general basket sitting there in the foreign sub. Okay, we're not there yet. So what happens next year? Next year we have income. We have income in all of our categories. We have to our preliminary subpart F income is our foreign-based company sales income, foreign personal holding company income, as earned for that particular year. We have this prior deficit, though, that needs to be recategorized. First off, since we don't have any deficit in this year, we're not offsetting one category against another. So we have right off the bat 35 of passive foreign personal holding company income in 2014. Then we have to reclassify foreign-based company sales income to passive to the extent that we had a deficit. And my spreadsheet here isn't quite right in this respect. Sorry about that. So we have 80 of income that was for the current year was general basket. 80 of it gets reclassified as passive because we had 80 offsetting passive above. And then the remainder of our foreign-based company sales income stays as foreign-based company sales income. Then in addition, we have a reclassification of this other income. We had 100 of deficit used against our, 100 of deficit in the general basket non-Subpart F used to offset Subpart F income in the prior year. So this 10 of other non-Subpart F income gets reclassified as Subpart F income this year. What that gives us for this year is all of our income, because of this 180 deficit, all of our income is Subpart F. We will have used part of our deficit in reclassifying the prior year deficits, so that we have a balance of deficit from prior years left of 15. And that'll be general foreign-based company sales income, because that's what was left. I will send out this example to you after the class, and I'll post it on Web Campus. So to recap this, when we have a deficit that reduces Subpart F income, we have to recapture that deficit in future years when we have other Subpart F income. In addition to current year deficits, we get to offset certain types of prior deficits against current year Subpart F income. The only deficits we can offset are those from qualified activities in the same chain of companies. And we'll get to that piece in a moment. Qualified deficits is deficits for sales and services income in the same company. And you have to look at the rules for what is a qualified activity to see whether a deficit from a prior year can be used to offset current year Subpart F income. I'm going to skip this example. I've distributed it in the notes pages so you can look at it. This is one I cover in the specialist class. For this class, I think it's important that you know prior deficits can be used. Just like current deficits, there's an ordering rule for where the deficits come into play. And the deficits have to be from qualified activities, meaning the same sort of active business stuff that generates either sales income or services income or oil-related income, same as what you're offsetting. In addition to the same company's deficit in a prior year or a current year, the U.S. shareholders may elect to reduce Subpart F income of a particular company from a deficit in a qualified chain member. I'm going to expand this up to have a little bit of a picture here. In this situation, U.S. shareholder owns F1, which owns F2. F1 has a loss, we'll say in foreign-based company sales income, of $50. F2 has a profit in foreign-based company sales income of $100. F2 can use F1's loss to reduce its Subpart F income. This is at the election of the U.S. shareholder. So it doesn't happen automatically. And there are situations where you might not want for this to happen. So you get to choose. Once this deficit has been offset, once you've reduced the 100 of income for the 50 of loss, in future years you have to reverse that when there is income up here. And those rules can get pretty tricky, and we're not going to go into those. Now there are some limitations on where you can do this, shown right here. It has to be a qualified chain member, and these are some pretty steep qualifications. First, has to be in the same country, and second, it has to be either 100% owned by the CFC or the CFC is 100% owned by it. This means this chain deficit rule only applies to 100% chains. It has to be 100% ownership up and down the chain. The offset can apply in either direction, either up the chain or down the chain. But it's got to be 100%, and it has to be from the same activity. If both companies are engaged in the widget business, then that's the same activity. If one is engaged in the widget business and one is engaged in building dams, that's not the same activity, and the mere fact that one has a deficit won't let you offset it against the other. Subpart F has some ordering rules to these categories and applying the deficits. First, the Subpart F income in excess of E&P is applied to each separate 904 category with a loss or zero E&P. Second, it's applied to each category with profits, and then third, applied to other categories. I have not been able to figure out in nearly 40 years of dealing with this rule, I'm sorry, this is a proposed, nearly 20 years of dealing with this rule, how you ever get to that third option. So when you encounter this, get out the regs and cookbook it. Now, as I've mentioned a couple of times before, any recapture of Subpart F income in future years is treated as being in the same Subpart F category as the deficit was. It's also treated as being in the same basket for foreign tax credit. And we've already pretty much covered what's on this slide. Now, when we have a dividend from a subsidiary that from whom we've had Subpart F income before, there's a coordination rule that says we don't get taxed twice. there's no double inclusion. Dividends are not included in anybody's income, whether an intervening company or the U.S. shareholder, when Subpart F income is distributed. Dividends are considered generally to be first from Subpart F inclusions and then from something else. The ordering rules in Section 959 are tricky, as between 956 and 954 inclusions. So you need to look at those when you're looking at a dividend to make sure you're applying them the right way. There is one thing that does happen on a distribution from a Subpart F income, and that is there is foreign exchange gain or loss recognized. If my UK subsidiary had 100 pounds of Subpart F income at a time when the pound was worth $1.50, then I had $150 Subpart F inclusion. If that sub a couple of years later distributes that 100 pounds at a time when the pound is worth $1.45, then when I get that distribution of $145, I have a loss. I previously included $150 of income, but I only got $145 due to changes in exchange rate. So that foreign exchange gain or loss on the distribution is recognized as ordinary income, just like the Subpart F income was. Now, I've said this before, and I'm going to say it again, Subpart F inclusions are not dividends. They are ordinary income. There are no special provisions for dividends that apply. Now, one thing I want to emphasize, I've said it just a couple of minutes ago, I want to emphasize it again. When that E&P, or when there's a dividend distribution, the recipient company excludes that dividend from its gross income. The earnings and profits, however, move up the chain, but there's an exclusion from income. So you have to track those E&P separately and track the Subpart F income separately. Now, this exclusion from gross income and the hopscotch effect of Subpart F can do funny things to your apportionment of interest expense within a CFC. Now let's talk a little bit, I'm going to skip this ordering rule for this class, with the exception of talking about this very first bullet point. A dividend is considered, a corporate distribution is considered to be a dividend to the extent of current or accumulated earnings and profits, and is considered to come first from accumulated and then, first from current and then from accumulated. That's straight out of Section 316. So when we have dividends coming up the chain that were Subpart F, we have to first apply Section 316 to see what it is, and then we have to go through the tricky ordering rule of Section 959. And with this, we conclude the bulk of our presentation on Subpart F. I want to mention one thing that I've mentioned before. That's the deemed paid credit that comes with Subpart F. it works the same as the deemed paid credit under 902. There was a law change a few years ago that coordinated the two, so they work exactly the same. There's a second aspect of a provision that's the mirror of Subpart F in the gain or loss rules, and we'll talk about that at some point. A shareholder of a CFC who sells the shares recharacterizes the gain on sale as a dividend to the extent of that shareholder's share of E&P. For corporate shareholders, that's a good thing. For individual shareholders, since dividends or qualified dividends and capital gains are the same, it's kind of neutral now. So we'll talk about Section 1248 next time around. So that is it for our Subpart F segment. I'd like to take a pause to drink my tea and leave kind of a quiet spot to be easy to find here. And now I'd like to start just a really, really quick guide to transfer pricing. This does not tell you everything you need to know about it. I encourage you to watch the video that I've got linked in Web Campus by a guy named Steve Rapp. Steve doesn't play it up much in his bio because he's limited to one paragraph. He used to be the director of the Advanced Pricing Agreement Program for the IRS. He is now with one of the law firms. He is one of the best there is on transfer pricing. And his presentation on CPA Academy is the best I've seen. So I encourage you to watch that. There are a couple of standalone quizzes associated with that. So it's a watch it, and the video answers everything you need to know. Section 482 is one of the shortest of all of the code sections. It's one paragraph. There are no subsections, no other parts. It's one paragraph. 482 basically says the IRS can adjust prices charged between controlled parties. You can charge any price you want. Transfer pricing rules do not say what price Company A has to charge to Company B. They do say the IRS, let me change this, the IRS can adjust prices charged between two related parties if they are under common control. This could mean two corporations. It could be two individuals that are related. It could be an entity and an individual. Doesn't matter. The IRS can adjust the prices. However, there are limitations in the regulations on when they can make the adjustment and how much adjustment they can make. The adjustment can happen only after testing prices that were actually charged to see if they are within an arm's length range. Arm's length is the magic word used in the international community in talking about prices between unrelated parties. Arm's length you've heard of as fair market value, meaning pretty much the same thing. It's a price that was charged by a willing seller to a willing buyer, neither being under any compulsion to act. Now, how do you find out such a price? Well, you're looking at transaction A, and trying to figure out whether it's arm's length. So and you know it's between related parties, how do you tell? Well, there are guidelines for testing in the regulations. If you get it wrong and the IRS comes in and adjusts the prices and the adjustment is big enough, you, the U.S. taxpayer, can face penalties of 40% of the additional tax, as well as interest and late payment penalties on that 40% and the tax. So the penalties can be pretty severe. The IRS regulations under 482 have standards for reliability of data, for comparability of data and prices, for how one goes about testing, and a whole bunch of other stuff. They're fairly complex, and these reliability and comparability rules are the driving force of all of the transfer pricing rules. Once you've gotten to the point of having reliable data, comparable data, then you have to also decide what the best method is for testing. The best method is the one that gives you the most reliable result. And for most kinds of prices, there are several testing methods available. Remember, these are not price setting methods. These are methods for testing prices charged to see whether they're arm's length. The key methods that apply to multiple different kinds of things are comparable uncontrolled prices, the resale price method, the cost plus method, and the comparable profits method. The regulations have a profit split method and a services cost method that apply in some situations. And in some types of pricing, there may be safe harbors. For instance, interest charged between related parties for US dollar denominated loans is considered arm's length if it's within 100% to 130% of the applicable federal rate for that particular length of loan. You've probably encountered that AFR test other places in your practice. There's often a lot said about transfer pricing studies. You do not need a transfer pricing study unless the IRS makes an adjustment, and then you need to have one, and you need to give it to them within 30 days, and it needs to support the prices you actually charged. So while you're not required under the regulations to do a transfer pricing study, a prudent taxpayer does one before finalizing prices. Because if you have a transfer pricing study and it supports the prices you charged and it's reasonable, then you get to avoid those huge penalties. So this was transfer pricing in a small nutshell. I encourage you to watch Steve Rapp's video. It's outstanding as webinars go. Now that gets us to the third segment of tonight's webinar. We're only going to spend about 15 minutes on this, and we're not going to cover everything here. I'm going to try to give you just a little bit of a feel for foreign currency concepts. Next week, we will cover more on foreign currency, and we'll do some exercises. I'll have the exercises out on Web Campus by the end of this week. We will do exercises in our two conference calls for next week. So the Wednesday a week from today, and Saturday a week from this coming Saturday. We'll cover those foreign exchange exercises. Most of the world does not use the US dollar as its currency. I know this comes as a great shock to you. Most countries have their own currency. And surprise, surprise, the value of those currencies in relation to the dollar changes from time to time, often minute to minute. If you go over to Europe and want to buy lunch, they're probably not going to take US dollars. They're going to want to take euros. Unless you're in the UK and they'll want pounds. Or unless you're in Switzerland and they'll want Swiss francs. And how do you take those green pieces of paper that represent value and get some funny colored pieces of paper with kings and queens printed on them that represent some different amount of value? Well, there are two ways. There's one way you can get the pieces of paper directly, and that's go to somebody that exchanges foreign currency. And they're going to charge you a spread, it's called. It's really a fee for doing the exchange for you. They're going to get a profit on every time they swap currencies, regardless of which direction it is. The other way you can do it, if you're an individual traveling like me, is you can go to an ATM and you can withdraw money in that foreign currency. So when you get overseas, you know, these things won't get you any place, but one of these will. If you go to a bank machine or a restaurant, and when you take money out of your bank account to buy foreign currency, just like those currency dealers, your bank is going to charge you a spread, and they're going to make a profit on every one of the transactions. Now, the spread at an ATM is going to be a lot better than the corner office swapping dollars for euros. If you're going to a major bank and swapping $10 million for 10 million, or for the appropriate number of euros, the spread's going to be very small. So that the rate at which you get some foreign currency is called an exchange rate. And this exchange rate is very important because it is that rate at the time you do something in a foreign currency that you use to record the transaction in the foreign currency. If I am in Paris and take a client out to lunch and we spend 800 euros at a nice restaurant, having only a cheap bottle of wine, I record that 800 euros in my functional currency of dollars at whatever the exchange rate is the credit card company charged me. Or I can use the exchange rate for the month. If I use some sort of averaging convention like that, that's a method of accounting. I'm stuck with how I was translating it until I get IRS approval to change my method of accounting. So exchange rate is one of the key terms that you'll encounter in dealing with foreign currency. We translate transactions from one currency to another at the spot rate. That means the rate at the time the transaction happened. If I buy some inventory and promise to pay for it in the future, I record the value of the inventory at the spot rate at the time I bought it. If I bought that lunch, I record it at the rate the bank charged me, the spot rate. Now there's some special rules for translating things other than transactions. There are rules for translating foreign currency or financial statements to the functional, to the reporting currency. Now, up here on transactions, I used another magic word, non-functional currency. I'm using functional currency here. What does that mean? Well, functional currency is another one of those magic terms. It's the currency of a business unit in which most of the business of that business unit is conducted. Now, what do I mean business unit? Well, it might be a subsidiary. It might be a branch. This is actually something where branch makes a difference in U.S. tax. Remember our example with the German company with the Ireland branch when we were talking about Subpart F? Well, the Ireland branch and the German branch happen to be on the same currency now. They both use euros. We also had an example we talked about with a Swiss company and an Ireland branch, the watch company, where Ireland was making the watches. Well, Ireland is on euros. That's their currency. And Switzerland uses Swiss francs. So in our Swiss-Ireland example, the functional currency of the Ireland branch was probably euros. And the functional currency of the Swiss Home Office is definitely Swiss francs. Now, why do I say the functional currency was probably euro for that Ireland branch? Well, let me give you an example from my own past. Years ago, I worked for a drilling company that was a subsidiary of a Fortune 100 company. And the drilling company was a two-thirds partner in a partnership. The partnership had some offshore drilling rigs in the North Sea. They bought the rigs using Norwegian kroner. They had revenues in US dollars, and they incurred all their operating expenses in UK pounds. What was their functional currency? Well, we ultimately decided that the UK pound was the functional currency because they were really doing more things in pounds and they were receiving part of their revenues in pounds. So that kind of outweighed everything else. Determining what a functional currency is can be tough. There are two situations where we have to have a specified functional currency. We'll not go into those. They can be tricky. But functional currency area is something that is unique under U.S. tax law. The regulations explicitly refer to determinations made for U.S. GAAP. If the functional currency for U.S. GAAP was determined to be the UK pound, then unless it is clearly erroneous, the IRS must follow it and the taxpayer must follow it. So little different rule there. So how do we as tax people determine the functional currency of something? It's real simple. We go ask the audit manager or partner, and they'll tell us, and then we don't have to worry about it. Each foreign corporation has its own functional currency. The foreign corporation may have multiple qualified business units within it that each have their own functional currency. Our Swiss sub with the Ireland branch is a good example. The corporation itself has the Swiss franc as its functional currency, and the branch has the euro as its functional currency. Now, how do we get those Ireland transactions into Swiss francs? The law says we have to translate using the P&L method. We determine the profit and loss for each QBU in its own functional currency, then translate that to another functional currency at a single rate for the year. We translate the net P&L. Now, there are proposed regulations that contradict the statute and say you have to do something different for a particular purpose. And it's my opinion, my humble opinion, that any regulation that clearly contradicts part of the law is not a valid interpretation of the law. So those proposed regulations from nearly 15 years ago are still proposed. They're not likely to pass, but if you like them, you can rely on them. And they give you a method called the temporal method that matches up very well with international accounting standards and also matches very well with the old Statement of Financial Accounting Standards number 8. Number 8 came out in 1978, and it was overturned with FAS 52, which is now codified as part of US GAAP. And FAS 52 uses the P&L method. So, there are some slides on qualified business units and gain on transfers, Section 988 events, and a bunch of other stuff in this foreign currency unit. We're going to be covering those next time, and after we've covered the 988 transactions and 988 recognition events, we're going to go through a bunch of examples. So next time we will move forward on our foreign currency issues coverage. And for tonight, that's where we will leave it, with you wondering, perhaps, what in the world is a qualified business unit? And there's a real good way to determine that, just like determining functional currency. Go ask the audit manager or the audit partner, because again, we have deferral to books. So, with that, I'm open for any questions. You all have live microphones that you can activate or put it in chat.